and navigating real estate financing, uh, it can feel less like a clear path and maybe more like a sprawling, complex landscape.
Yeah.
You know,
Yeah.
there are different routes you can take, like the loan types, specific landmarks, maybe the legal documents, and then all these intricate rules of the road, the regulations and disclosures. It's definitely a lot to take in.
It really is. And if you're the one guiding someone else through it, maybe a client, you need to feel, well, absolutely solid on the fundamentals yourself. That lack of clarity, that's often the biggest source of anxiety in the whole transaction.
Exactly. And, that's really why we're doing this deep dive. Our mission here is to cut through some of that complexity. We've taken the source material, you shared all those articles, the details on loan types, the breakdown of consumer protection laws, and we're going to try and distill it all.
Yeah, get to the core stuff.
Get to the most essential, actionable knowledge for you. Think of this maybe as building your map for this financing landscape.
We're pulling insights directly from documents that cover key loan types, the foundational legal agreements, and they really dive deep into those crucial federal consumer protection laws like TILA and RESPA and the disclosures they require. It's about giving you the clarity needed to navigate this with, well, confidence.
All right, let's start building our map then. Let's look at some of the main routes available, the different types of loans the sources outline. Understanding these variations is really step one, to figure out what might work best for a client.
Yeah, the sources give us a pretty clear look at FHA and VA loans, and they often compare them sort of implicitly to conventional loans, which kind of serve as a baseline.
Okay, so lay out FHA loans for us first. According to the sources, what really makes them stand out?
Okay. So they're backed by the Federal Housing Administration. That makes them pretty accessible to the general public. A key feature, and this comes up a lot, is flexibility with down payments.
Ah, the down payment.
Yeah, the sources note you could potentially put down as little as 3.5%, provided you have a credit score of 580 or higher, and even 10% down if your score is between 500 and 579. That's generally lower and maybe more forgiving than a lot of conventional options.
That flexibility definitely sounds good. Is there a trade-off? What do the sources point to?
Well, the primary point the sources highlight is the requirement for mortgage insurance premiums,
Sorry.
MIP.
Talk?
You pay both an upfront premium and an annual premium, and critically, this annual premium usually applies for the life of the loan. Unless you put down 10% or more, then it might drop off after 11 years. But yeah, it adds to the overall cost. The sources definitely flag that as something to weigh against those lower upfront costs.
Got it. So a cost factor there. The sources also give us the 2025 loan limits for FHA, and they vary significantly by location, right? From about $524,000 in low-cost areas, way up to over $1.2 million in high-cost areas.
That's right.
And they emphasize a property requirement. It absolutely must be the borrower's primary residence, and it has to meet FHA's minimum property standards.
That's correct. And the debt-to-income ratio, your DTI, right? How much of your gross monthly income goes toward debt payments that can be higher for FHA? The sources say up to 50%.
Okay, so FHA offers flexibility on down payment and credit, but you've got that mortgage insurance factor.
Right.
Now let's switch gears to VA loans. These are specifically for military members and veterans.
Correct. Yeah, these are guaranteed by the Department of Veterans Affairs, and they are a huge benefit for eligible individuals. We're talking service members, veterans, National Guard and Reserves members, and also some surviving spouses. The defining characteristic, the one the sources mention again and again, is the potential for a $0 down payment.
Zero down. That's a big difference. What about the credit score requirement?
Well, it's interesting. While the VA itself doesn't actually set a minimum score, the sources are pretty clear. Lenders typically require a minimum, and they often cite 620 as a common benchmark that lenders look for.
Okay, so lender requirement there. And interest rates, how do they compare?
The sources indicate that VA loan interest rates are generally slightly lower than FHA rates.
And property type, same requirement.
Yep, just like FHA, it must be the borrower's primary residence, and it has to meet the VA's minimum property requirements.
Okay.
And the courses also give some really helpful detail on surviving spouse eligibility. They list the specific documents needed, things like a marriage license, the veteran's death certificate or that report of casualty, the DD Form 1300, and the veteran's separation paperwork. You'd need to request that from the National Archives. Knowing exactly what docs are needed can be a huge help for a surviving spouse client,
Oh, yeah, that's a really practical detail.
Okay.
The DTI for VA loans, the sources say that's typically capped lower than FHA, around 41%.
Right.
And unlike FHA, there are generally no loan limits if the borrower has their full entitlement. That gives more flexibility, maybe in those higher cost areas. There is a fee, the VA funding fee, but often that can be financed into the loan.
Absolutely. And just understanding these core features, who qualifies, the down payment options, those lender credit score minimums, the property rules, key costs. That's how you start putting that map together for your client.
Right.
You can quickly get a sense if a client might be a good candidate for one of these specific loan types and then, guide them toward talking to a lender early on. It's really about having those informed initial conversations.
It absolutely is. You're not trying to be the lender, of course, but you need enough of that foundational knowledge to help clients explore the right paths early.
Precisely.
Okay, so once a client and lender maybe identify a potential loan type, what are the actual legal documents that solidify this whole arrangement?
The sources mention two fundamental players in, well, any real estate financing.
Yeah, they refer to the note and the security instrument. These are really the core legal pieces in the loan transaction. They get referenced specifically when we start talking about the closing disclosure later. And the sources are really explicit that these transactions are secured by real estate or a dwelling. That phrase seems important.
Yes, that phrase is key. It just means the property itself is the collateral for the loan. The sources kind of reinforce this by stating the TILA-RESPA rule applies to most closed-end mortgage loans, and that includes loans secured by vacant land. So the legal instruments are what create that security link.
So you have the note, which is essentially the borrower's promise to repay the debt, that IOU.
Yeah, the promise to pay.
And then the security instrument is the document that ties that promise to the property, allowing the lender recourse if, the promise isn't kept.
That's the functional relationship, exactly. The sources refer to security instruments like a mortgage or a deed of trust.
Right. And the sources do mention deed of trust versus mortgage as a related topic. But crucially, they don't actually provide details explaining the functional difference between them, or how they operate specifically in California, for instance, or even how they differ legally from the promissory note itself.
That's a limitation, and it's based only on the source material we're working from here. So while these instruments are absolutely fundamental to the transaction, the specific legal nuances of how they differ or how they operate in a particular state like California, they just aren't detailed in these specific sources.
Okay.
So we only know they are referenced as the documents used in transactions secured by property, and that they are part of the transaction documents subject to disclosure rules, like the closing disclosure.
Okay, so the sources tell us the note is the promise, the security instrument, like a mortgage or deed of trust, ties that promise to the property as collateral. And these are key legal pieces governed by pretty extensive regulations.
Exactly. And just understanding that basic structure, the debt itself, the note, and the legal mechanism making the property the backup plan, the security instrument that's foundational to grasping how heavily regulated these transactions are, which is our next crucial area on the map.
And this is where things get really intricate, isn't it? Diving into the regulations designed to protect consumers and ensure transparency. The sources provide, well, significant depth here on TILA and RESPA.
Absolutely. The Truth in Lending Act, TILA, and the Real Estate Settlement Procedures Act, RESPA, they are the major federal players here. And a lot of their implementation and enforcement falls under the Consumer Financial Protection Bureau, the CFPB.
And together, they gave us TRIDE, the TILA-RESPA Integrated Disclosure Rule, right?
Correct. TRID. It was created specifically to combine and hopefully simplify disclosures that used to come separately from TILA and RESPA, and it applies to most closed-end mortgage loans. The sources even specify this includes things like construction-only loans and loans secured by vacant land, so it shows you the broad reach.
And the two main forms that everyone sees under TRIDE are the loan estimate, the LE, and the closing disclosure, the CD. Let's maybe look at the LE first. What's its core purpose based on the sources?
The purpose is really to give consumers a clear way to understand the key features, the costs, and the risks of a potential loan. And importantly, to make it easier for them to compare different loan offers side by side. It's meant to be that initial snapshot.
And for you, helping a client knowing the timing is just critical here.
It absolutely is. The sources state the LE must be provided no later than 3 business days after the lender receives what's considered a complete loan application.
Okay, 3 business days.
And they define exactly what complete means. The consumer's name, their income, their social security number for the credit report, the property address, an estimate of the property value, and the specific loan amount the consumer is seeking. All 6 of those pieces are needed to start that 3-day clock.
That's a really key detail for managing client expectations about when they'll see that form. What information is front and center on the LE? What should people look for?
Yeah, the sources detail the layout pretty well. Page 1 gives you the big picture, general info, the specific loan terms like how long the loan is, the interest rate type, is it fixed, adjustable, etc., and any potentially risky features like negative amortization or balloon payments. Then projected payments over time and a summary of the estimated costs at closing. It's really designed for easy scanning initially.
And page 2 gets into the nitty-gritty of those costs.
Exactly. It itemizes the loan costs, and that includes origination charges from the lender, costs for services the lender chooses that you cannot shop around for, like maybe the appraisal or the credit report provider they use, and then costs for services you can shop for, like title insurance or a pest inspection, where the lender might give you a list, but you can choose your own provider. Then there are the other costs, like taxes, prepaids, and the initial escrow payment.
Okay. And page 3 gives you contact info and resources.
Yeah, contact details for everyone involved, a link to the CFPB website, which is a great resource for shopping, or if you have complaints, and sometimes notes like the appraisal notice. It's all geared towards transparency.
The sources also bring up revised LEs. When does that happen? Is it common?
Well, a revised LE is required if there's a valid change circumstance. Things change, right? The timing rule is generally within 3 business days of the lender becoming aware of that change. But, and this is crucial for you advising a client, a revised LE must be provided no later than 4 business days prior to consummation. That specific deadline is really important for avoiding delays at closing.
4 business days before consummation for a revised LE.
Got it. Okay, so that's the LE, the initial estimate.
Yep.
The closing disclosure, or CD, that's the final picture, right?
Precisely. The sources state the CD's purpose is to help consumers understand all the final costs of the transaction right before they close. The final numbers.
And the timing here is even more critical, maybe even more sensitive. It absolutely is. The CD must be provided no later than 3 business days before consummation. And the sources really clarify what consummation means in this context. It's when the consumer becomes legally obligated to the creditor on the loan, based on state law.
Okay, so it's not necessarily when they sign the purchase contract with the seller. That's a vital distinction.
Exactly. It's about becoming obligated to the lender under state law.
So that 3-day wait before signing the final loan documents is usually non-negotiable. Are there any exceptions the sources mention?
Well, the sources mention that for timeshare loans, the CD can actually be received at or before consummation. And a consumer can waive the 3-day waiting period, but only for what's called a bona fide personal financial emergency. And they have to provide a specific written statement detailing the emergency. It's a high bar.
Okay. What happens if something changes right at the last minute? After the CD is issued, but before the closing actually happens?
Yeah, that can happen. The sources identify 3 specific changes that will trigger a new 3 business day waiting period before consummation can occur.
Okay, what are they?
1, if the annual percentage rate, the APR, that's the total cost of the loan, expressed as a yearly rate, if that changes outside certain defined tolerances. 2, if the loan product itself changes, like maybe switching from a fixed rate to an adjustable rate. Or 3, if a prepayment penalty is added to the loan.
So those 3 things reset the clock.
Those 3 reset the 3-day clock. Other changes might require a corrected CD, but they don't necessarily reset the waiting period. The corrected CD just needs to be provided at or before consummation. This tells you exactly what kinds of changes are likely to cause a significant delay.
What does the CD actually show? Is it just the LE numbers but finalized?
It covers very similar categories as the LE, but yeah, with the final figures. The sources describe it including the updated loan terms, the final projected payments, and then those itemized lists of loan costs and other costs. And it clearly shows who is paying each fee borrower, seller, or others. It also has summaries of the borrowers and sellers' transactions and, crucially, the final cash-to-close calculation.
What about page 4?
Page 4 details the escrow account setup, or it confirms if there isn't going to be one.
And page 5 summarizes all the final loan numbers.
Yes, that's where you find the final total of payments, that's principal, interest, mortgage insurance over the whole loan, the finance charge, the total amount of interest and fees paid over the life of the loan, the amount financed, the final APR, and the total interest percentage, or TIPP. That's the total interest paid as a percentage of the loan amount.
Wow.
It also includes other important notices like warnings about potential refinancing difficulties or recommendations to consult a tax advisor about deductions, and contact information. The sources also specifically note the required language for the confirm receipt statement, clarifying that signing it only confirms they received the document, not that they actually accept the loan terms.
This really points to the need for accuracy between that initial estimate and the final numbers. The sources discuss accuracy tolerances between the LE and CD, right?
They do, yeah. And this is key for managing client expectations about costs. Some charges on the LE have zero tolerance, meaning they absolutely cannot increase on the CD unless there's a valid changed circumstance. Think lender fees.
Well,
Other fees have a 10% tolerance. The total sum of those specific charges cannot increase by more than 10% in aggregate. And then some charges have no tolerance restriction. These are usually fees for services the borrower chose themselves if they weren't on the creditor's recommended list, or things like the owner's title insurance policy. Knowing these categories helps you understand if a final CD has unexpected increases, that might be a red flag, or if they fall within the allowed limits.
and all these regulations mean lenders have to keep really detailed records of these disclosures for a long time.
Yes, the sources mention specific record retention requirements. Generally 3 years for most TILA records, but specifically 5 years for closing disclosures. Compliance is definitely a long-term commitment for lenders.
So beyond just the tried forms, TILA itself has other really crucial consumer protections the sources mention.
Definitely. TILA is fundamentally about the cost of credit, right? So it has a very clear definition of the finance charge. It's the costs payable by the consumer related to actually getting the credit, think interest and certain fees, but it specifically excludes charges that would exist even in a comparable cash transaction, like property taxes or title fees.
Okay, that makes sense.
And the accurate calculation and disclosure of the APR, the annual percentage rate, that's also absolutely central to TILA's purpose.
They also touch on high-cost mortgages briefly. What's the deal there?
Yeah, the sources note that special rules apply to loans where the rates or fees exceed certain thresholds, making them high cost. For these loans, the lender must assess the consumer's ability to repay, and importantly, the consumer must receive pre-loan counseling from a HUD-approved counselor before they can close.
Mandatory counseling.
Mandatory counseling. The creditor can even pay for the counseling, but they cannot condition that payment on whether the loan actually closes or not. It's a pretty serious layer of protection for potentially risky loans.
And rules around who actually originates the loan officers.
Yes, loan originator compensation is regulated too. The sources mention rules prohibiting what's called dual compensation, basically, being paid by both the consumer and another party, like the lender, in a transaction secured by a dwelling, though there are specific exceptions. Originators also have character and fitness standards they need to meet, and their name and their NMLSR ID must be on the loan documentation for most closed-end loans. It's all about accountability.
There's also a really powerful consumer right mentioned, the right to rescission.
Yes, this applies to certain loans secured by a principal dwelling, but importantly, not purchase money loans. Think more like a refinance or a home equity loan.
Okay, not for buying the house initially.
Right. For those specific loan types, consumers have a right to cancel the transaction within 3 business days after receiving the last of 3 things: the loan documents, the final TILA disclosures, or the notice of the right to rescind itself. Whichever comes last starts the clock. The sources specify creditors must provide 2 copies of this rescission notice to each consumer who has an ownership interest in the property. It's like a built-in cooling off period.
It's a very comprehensive look at TILA and tried. RESPA also has some vital protections, particularly after the closing happens.
Right. Section 8 of RESPA, as noted in the sources, specifically addresses the prohibition of kickbacks and unearned fees in real estate settlement services. It's really aimed at preventing shady referral fees that could inflate costs.
And then there's that whole area of mortgage servicing rules under RESPA. This is after you have the loan.
Yeah, this is a significant focus in the source material. Servicers, that's the company you actually make your mortgage payment to, they have very clear obligations. For instance, they must make timely escrow payments for your taxes and insurance by the deadlines to avoid penalties. And if you pay off your loan entirely, they generally have to return any excess funds left in your escrow account within 20 business days.
What if a borrower spots an error on their statement? Or just has a question after closing?
RESPA outlines specific error resolution procedures. If a borrower submits a written notice of error, it usually has to be written. The servicer has to acknowledge it within 5 business days. Then they have to investigate and respond, usually within 30 business days. There are even shorter timelines for really urgent errors, like those related to payout statements or an impending foreclosure.
So there's a formal process.
A formal process, yes. Similarly, servicers must respond to written information requests within specific timelines, acknowledge within 5 business days, respond within 30 business days. This includes requests about who actually owns the loan, which can sometimes change. It gives borrowers a defined path to get issues resolved or questions answered.
And what about that force-placed insurance, when the lender buys insurance for you?
Right. The sources detail the rules governing when a servicer can charge a borrower for hazard insurance that they place on the property, usually because the borrower's own coverage has lapsed. There are specific notices required before they can charge you, and the cost of that insurance must be bona fide and reasonable. It's meant to prevent servicers from just hitting borrowers with unexpected, maybe inflated insurance costs without any warning.
Finally, what if a borrower is really having trouble making their payments? Does RESPA cover that?
It does. RESA includes early intervention requirements for delinquent borrowers on principal residence loans, though there are some exceptions for small servicers. Servicers must make good faith efforts to establish live contact with the borrower by the 36th day of delinquency.
Live contact.
Live contact, yeah, phone call usually, and inform them of loss mitigation options if appropriate. This is really designed to try and catch problems early before they potentially escalate into foreclosure.
And what if a borrower formally applies for loss mitigation, like asking for a loan modification?
Yeah, the sources describe some pretty strict procedures there, too. If a servicer receives a complete loss mitigation application at least 45 days before a scheduled foreclosure sale, they generally have to review it and make a decision before the sale can proceed. They have to acknowledge receiving the application within 5 business days. They also have to exercise reasonable diligence to get any missing information needed to complete the application, especially if it's information that isn't in the borrower's direct control. And importantly, they cannot deny a complete loss mitigation application solely because they lack required documents that were outside the borrower's control and which the servicer was unable to obtain despite trying. It creates a clear, structured process for homeowners who are seeking help to avoid foreclosure.
Wow. Okay, so we've really covered the landscape here. The different loan type routes like FHA and VA, the fundamental legal instruments, the note and security instrument that secure the property, and then these really detailed rules of the road laid out by TILA and RESPA, particularly around the upfront disclosures like the LE and CD and all those post-closing servicing rules. Now, the big question, what does having this map, this understanding, actually do for you, the listener, especially if you're guiding clients through this whole process?
Well, fundamentally, it empowers you.
Right.
Understanding the purpose and maybe even more importantly, the timing of forms like the loan estimate and closing disclosure, knowing the rules behind fees, those tolerance levels, the servicing requirements, it gives you concrete knowledge you can share with your clients.
Yeah, you can manage expectations for your clients like a pro. You can explain why they get the LE within 3 days of applying, why there's that mandatory 3-day wait for the CD before they can sign the final loan documents, and what kinds of last-minute changes might actually trigger a delay. Just anticipating those steps can reduce anxiety significantly.
Exactly. And knowing the basics of those fee tolerances means you can help them understand potential cost variations between the estimate and the final numbers. Knowing about things like, say, loan originator compensation rules or the servicing requirements for handling errors means you can help them spot potential issues maybe, or just guide them on what to expect after closing, like if their loan servicing gets transferred.
Ultimately, being this informed guide through what is often the most complex and, frankly, intimidating part of the purchase process, the financing, it builds incredible trust with your clients. You're not just showing them houses, you're helping them navigate this huge financial step.
And that directly translates into peace of mind for them. Turning what can feel like a confusing, anxiety-ridden process into something more predictable and understandable just by using your knowledge of these regulations and disclosures, that's invaluable.
This deep dive has really highlighted just how layered and specific the rules are governing real estate finance, from the initial application all the way through to how the loan is serviced years down the line, the level of detail required in those disclosures, the LE and CD, and the really strict procedures for servicers, from handling errors to engaging with delinquent borrowers. It just underscores the significant regulatory effort that's aimed at consumer protection.
Yeah, it really shows that compliance isn't just some box that lenders check off. It's this intricate system designed to ensure transparency and provide specific rights and processes for borrowers throughout the entire life of the loan.
Thinking about the complexity of these rules,
Yeah.
how they vary slightly between loan types like FHA and VA, or how special rules kick in for things like high-cost mortgages or loss mitigation, It really becomes clear that staying informed isn't just a one-time event. It's got to be an ongoing necessity for everyone involved in this industry, right? Agents, lenders, everyone.
Absolutely. What kind of stands out is how this detailed regulatory framework, as complex as it is, creates these necessary guardrails for the transaction. It forces a certain level of communication and documentation that's designed ultimately to give consumers a clearer picture of their debt and their rights. Which maybe leads to a final thought. How does this continuous process of regulatory refinement, this constant adjustment, continue to shape the balance between trying to achieve a smooth, efficient lending process and ensuring robust consumer protection in what's always an ever-changing market?